Let's talk about a Social Security bridge strategy. This is one of those things where people often end up just doing it on their own without knowing that it's a fancy strategy or necessarily even caring. But other people can really benefit from hearing about how it works and understanding some of the benefits. So you can potentially maximize your retirement income. You can manage your risk in retirement. That's especially helpful in those later years. You can open the door to some nice tax strategies. You can potentially provide for a surviving spouse, and there may be some other benefits. So that's what we're going to talk about in the next couple of minutes here. We'll go over what the strategy is, how it works, some of the pros and cons, and then a couple of the tips that might help you use it effectively. Most people take their benefits early, meaning age 62 or somewhere close to there. So you can claim as early as age 62, and then you might claim as late as age 70. Claiming early allows you to get that income as soon as possible, but it results in a reduced income, and we'll get into those numbers in a second. So that's not necessarily a bad thing. There could be perfectly good reasons for claiming early, and there's no shame in that. But if there is a better strategy that can help you make the most of your money and your income, it's at least worth exploring. So a bridge strategy could make sense for anybody who retires anytime before their late 60s, let's say. And when you do that, you retire, but you don't take benefits yet. Where do you get the money from to pay your bills? Well, we're going to answer that question with a bridging strategy in mind. This is something that you can implement on your own. This is also something that they're talking about adding to retirement plans at your workplace, like a 401k, for example. But it really is something you can customize on your own. I often find that clients want to kind of utilize it and maybe totally use it, wait till age 70. But let's talk about exactly what all of that means. So a simplified explanation of what it means is this: you stop working, but you don't necessarily start your Social Security retirement benefit right away. Instead, you would draw from your savings and investments, anything you've earmarked for retirement. That might be in your IRA, 401k, 403b, TSP, wherever you have some retirement assets saved. You draw down those assets, and it might be at a relatively high rate. During that time, your Social Security retirement benefit should be increasing, which will help you out later. Once you reach the appropriate age, whatever that might be, you turn on your Social Security benefit, start taking income, that higher income than you would have gotten earlier, and that will result in smaller withdrawals. In other words, you'll be pulling from your accounts at a lower withdrawal rate, which makes your money presumably last a bit longer. So let's put some numbers to that. The Social Security Administration gives us some sample statements to look at. We might say you stop working at age 62 here, and your benefit might be $14.65 per month. So if you wanted to use a Social Security bridge strategy, you would not claim right away and get that $14.65 a month. Instead, you would withdraw $14.65 a month from your savings, and you do that for a number of years. As you can see, your benefit will increase year by year as you delay, and in fact, it's a monthly increase, a small monthly increase. Then at some point, we would turn on your Social Security benefit and reduce those withdrawals from your savings. Now, that's just a sort of simplified example. If you need to adjust for taxes, for example, you might need to pull out a little bit more each month, and you don't necessarily need to follow what's on your statement very rigidly like that. You could, for example, take out a different amount. You might end up just doing this for a number of years, maybe even just a number of months. You don't necessarily have to wait until age 70 or wait until your full retirement age to turn on your Social Security benefit. This is really something you can customize and make work for you however is best. It's really important to maximize that Social Security benefit wisely because it has a couple of unique features. Number one, it's government guaranteed, so it's quite safe. Unlike let's say a private pension from an employer or an annuity that you might purchase from an insurance company, those are both fairly safe, unlikely to run out of money or go belly up. But a government guaranteed payment is even safer. It's also an inflation adjusted payment. So we can look at the Social Security Administration's history of the cost of living adjustments, and you can see that, maybe it doesn't match your inflation perfectly, but there are some nice increases here. In periods when inflation is high, they tend to make some adjustments that can help you out. Now, inflation can wreak havoc on a retirement strategy if you're taking withdrawals from a portfolio, especially if that inflation happens to correspond with some market downturns while you're taking bigger withdrawals. So this can be certainly helpful for you as you plan for a lifetime of income. And speaking of lifetime income, it is guaranteed to last for your life. So the Social Security payments would continue for as long as you live, whether you live to be a very old age or not so much. That again is a way to avoid running out of money during your life. So if you run out of money, like run out of assets, for example, you would still have some income coming in, and that's especially helpful if you have boosted or maximized that income that you're going to get from Social Security. So one more reason to consider this bridge strategy. And finally, the calculations they use could be based on some life expectancy tables that reflect people with health that is maybe not as good as yours. So if you happen to be fortunate, let's say, that could be a really good way to get some income that might be better than some of the alternatives out there. So we'll dig into these pros and cons just a little bit more. Now, I am Justin Pritchard. I help people plan for retirement and invest for the future. And in the description below, you're going to find some resources I think you'll find helpful. Some of it is the things that we have been looking at here. There will also be some information on more general retirement planning. And I think that stuff could be really helpful for you as you plan for your future. Also, a friendly reminder, it's just a short video. It can't possibly cover everything, so please talk with some professionals and do a lot more research before you make any decisions on these important topics. Please hit pause and read that if you need more time. So let's talk a little bit more about those benefits. The big one, of course, is that you can maximize your income in retirement. So that helps you meet your monthly expenses and pay for those wants and needs during your retirement years. The reason for that, of course, is that your benefit amount is based in large part on the age at which you claim. It also depends on how much you earned during your lifetime, and then some inflation adjustments will also kick in. But for most people approaching retirement these days, full retirement age is around age 67. And so again, you can claim as early as age 62. But if you do that, you get only 70% of your FRA, or your full retirement age amount. So in other words, for every $1,000 that you would have received, you would get only $700 per month, and that reduction sticks with you for the rest of your life for the most part. On the other hand, if you delay claiming, you can get quite a bit more. You can get a bonus of what amounts to about 8% per year. Technically, these increases happen monthly, so you don't have to wait until a calendar year or until your birthday necessarily to get these bump ups in your benefit. So you can, again, customize this for however it's going to work best for you. But again, the longer you wait to take benefits up until age 70, the more you generally get. Another benefit of a bridge strategy is that you can reduce your risk. And again, that's especially helpful in your later years. So instead of relying on your investments and the markets to provide the resources you need for the rest of your life, you can rely on retirement income that happens to be, again, government guaranteed, inflation adjusted, lifetime guaranteed, and all that stuff. While we might certainly expect the markets to continue to, mostly grow for the most part, again, with those inevitable market crashes and pullbacks and stagnation times and all of that, we might expect those to produce some decent returns in the coming decades, but there's really no guarantee. And if you suffer from some bad timing, that can be especially bad. So one way to think about this is to say, you know what, I might go ahead and spend down some of those assets and let that benefit grow, and that might work out just as well or better. Next, if you happen to be married and there's a spouse who might take over your retirement benefit, then waiting can be beneficial for that person. So when you pass away, let's say you've got a higher retirement benefit from Social Security, your surviving spouse could eventually effectively take over the bigger of their payment or the biggest payment that you were entitled to at the time of your death. And if you wait, if you delay claiming, let's say until age 70, you have maximized your benefit, and that will be the benefit that's available to the surviving spouse. That can be really helpful because remember, when one of you goes, then only one Social Security payment is coming into the household each month. There's less money to work with. Likewise, the surviving spouse might be in a single tax filing status in future years, and that just increases the burden that they might have if their income is more or less similar to how it would have been. Again, that Social Security payment goes away, but if they're taking withdrawals from accounts, then that can mess them up tax-wise. And speaking of taxes, this bridging strategy or waiting to claim benefits can open the door to a number of different strategies and opportunities. For example, if you stop working but you don't take benefits right away, then you might have a number of years where you have a relatively low income because you stopped earning your paycheck at work and you're not getting a Social Security payment. During those years, you might be able to maybe do Roth conversions. In other words, intentionally pay taxes on some pre-tax money in your IRAs and convert that to what could potentially be tax-free income in retirement. That could be really helpful for you during those low income years when you are presumably in a relatively low tax bracket. You might also just pull income out of those pre-tax accounts and kind of spend it down. You might do that just to spend what you need, or you might decide that there's a tax bracket you're willing to go up to, and you could fill that tax bracket at a rate that's acceptable to you. By doing either of those, you're going to reduce the amount of money that you have in those pre-tax accounts, and that can be helpful later because it will reduce the amount of your required minimum distributions or your RMDs. Remember, at age 72 or later, or whatever lawmakers make the age after this video gets recorded, the IRS requires that you take distributions out of those pre-tax accounts. That might end up having you pull out more than you wanted and needed. It could potentially bump you up into high tax brackets that you don't want to be in. It could also affect your healthcare costs. So the amount of income you show on your return can impact how much you pay for Medicare, for example. If you go above certain limits, then you are going to have to pay higher premiums for your Part B and your Part D coverage in Medicare. So that's one reason to consider trying to reduce the amount in those pre-tax accounts so that in turn you can reduce the amount you take in RMDs later in life. Of course, nothing is perfect, so let's talk about some potential pitfalls you might face if you decide to use a bridge strategy. The most obvious one for people is that you have less money. You're going to be spending down your assets, and that can seem quite precarious, and it can actually cause problems if you end up just totally wiping out everything you have saved for retirement. I don't necessarily think it's a great idea to get rid of all of your retirement savings just so you can get a bigger Social Security check. It just depends on the numbers. You have to look at the details. That said, having that cushion feels good for a lot of people, so it could just cause you some anxiety and be unacceptable if it means you're going to spend down way too much. There's also the question of longevity. So if you have some known health issues and you don't expect to live a long life, then it might not make sense to delay taking your benefits. It might make sense to claim as soon as you can, let's say that's age 62, and get those payments coming in so that you can use the money and spend it and enjoy your life. There's also the question of maybe you want to keep that money invested instead of drawing it out and spending it down. I would say this is a risky one. That's on you if you want to go that route. It's hard to outperform, and it's certainly an unknown, so who knows what'll happen. But for some people, they just want to keep that money invested and hopefully see it keep growing instead of spending it down. I would point out this isn't necessarily a perfect calculation. We're kind of looking at fuzzy lines here and ranges, but in order for that investment strategy, that outperformance strategy to work out, you might need to have some decent returns. So with higher expected returns, again, no guarantees that anybody's going to get these. You would have to take some risk to get these higher returns. Then the strategy might look better. But if you're a more conservative investor, the question becomes, are you going to get those types of returns? And might it make more sense just to hold off on taking Social Security and maybe spend some of that money? You might also have some legacy goals. So if you want to leave money to loved ones or to a charity, then spending down those assets can seem like the wrong thing to do. Now, what you want to do is maybe run some numbers, because yes, you're going to be withdrawing at a high rate early on before you take your Social Security benefits. But later in life, you will be taking presumably smaller withdrawals from your portfolio, and that could help to preserve it and possibly even grow it. Again, it just depends on the details. We can't say for certain or generalize or anything like that, but there's a possibility that you could still leave a decent and maybe even better legacy for the people or causes you care about if you use that bridging strategy. So don't necessarily rule it out if you have legacy goals. So now let's get into maybe some ideas on how to make this happen and improve the chances of it going well for you. First, we want to plan ahead for those low income years. So when you stop working, you're not taking benefits yet, what are you going to do during those years? Does that involve Roth conversions? Does it involve just taking out enough to get up to a certain level for tax subsidies or ACA credits when you buy healthcare insurance, for example? What exactly is your plan during those years? You want to figure that out ahead of time so that you're ready to put it into action. We also want to know where you're going to pull money from. So you need to have some assets available that are accessible and that are invested appropriately for you to start taking withdrawals. And especially if you retire early, that might even be before Social Security is an option for you. You want to make sure you have accessible accounts or some strategies that can help you get to that money. That might mean taxable accounts, might mean Roth money, might mean a number of different things. But again, look ahead and say, where am I going to pull that money from? Which accounts will I use? Which investments is the money in right now? And is that the right investment? You also want to model the drawdown and figure out what it might look like how low might your account balance get, and are you comfortable with that? And is that a good idea? So run some numbers, do some projections, some of them more optimistic, some of them more pessimistic, so that you can get an idea of how this thing might unfold. Of course, we can't predict the future perfectly. We can be vaguely right, but we will be precisely wrong, and that's the best you can do. So run those projections and just get an idea of whether or not it looks reasonable to you. So I hope you found this helpful. If you did, please leave a quick thumbs up. Thank you and take care.